Good afternoon and welcome back, everyone, to our Options Education webinar series. My name is Tony Zhang. I'm the Chief Strategist here at OptionsPlay. And this week, we're going to be talking about how to grow your trading account consistently, specifically for those of you that are looking to generate income on a more consistent basis, doing it so weekly so that you can consistently grow your trading account. We're going to talk about a single strategy that will be dedicated to helping you do that. So, out of all of the different option strategies you can potentially learn to trade, this is the one that I advocate. If you're first starting out, you should be learning how to master this one strategy. And that's what we're going to go through during today's session, and we will make sure that we will help you understand this specific strategy, specifically in the context, especially if you have a smaller account, how you can learn this one strategy to help you consistently grow your account week after week uh, with uh, with with options play. So what I can do is I want to make sure that everyone understands that on Thursday afternoons, what we are dedicated here to do is our education sessions, which are designed to empower you to trade sustainably and confidently. That, in short, means that we're here to try to help round out your education so that you are focused on how to grow your account in the long run. That means that you're going to need more than just options. You need to learn things around technical analysis, fundamental analysis, money management, trading psychology. We're trying to provide you with a well-rounded education to help you grow your account in the long run. And this is a part of that process today, where we are going to focus more so on the options strategy aspect of growing your account with an options account. Now, before we get started, what we are going to discuss here today is purely for education and demonstration purposes. It is not a solicitation or recommendation to buy or sell any of the specific securities I'll be using as example purposes during today's session. So, what we're going to start off with is just first understanding, what does it take to grow an actual account? What things do you need to have in place in order to have the confidence and the abilities to grow your account in the long run? Then we're going to talk about a simple and forgiving option strategy. This, like I said, it's the number one strategy that I think if you are trying to learn how to grow your account, that you have to learn how to master. And yes, this is a session that I have taught before, but I'm teaching it again because of how important it is for everyone's portfolio to understand the strategy fundamentally, understand why it works, how to find the best trading setups in order to help you grow your account. We're going to go through a live trading example. I always find that's the best way to help you learn. And using that live example, I want to show you why that specific trade gives you an edge as a trader. And then we're going to show you how you can find real-time trading signals, just like the one that I'm going to show you during today's session every single day in your account, and show you kind of some of the trading signal examples with that type of real-time trading signals. And then we'll open this up for Q&A here at the very end. But I already see many of you chiming into the chat window. So if you are joining us for the first time, please feel free to say hello into the chat window. As you can see, we have a vibrant community of traders from all over the world. Please chime in, let everyone know where you're from, and let's go ahead and get started. But before we do, what I want to make sure you get out of today's session is a clear understanding as to how can I generate consistent income in any market using credit spreads. And that is a strategy we're going to spend our time learning how to master during today's session. So many of you are asking me, are these sessions recorded? Can I get slides afterwards? And the answer is yes to both. And also, what I'll be showing you during today's session is a tool to help you generate income and help you find these specific trading setups that provide you both a directional edge as well as an options edge. So to access the tools that I'll be showing you during today's session, you either have to have a free trial to OptionsPlay or a membership. So if you're starting off and you want to start with your free 30-day trial, you can start at optionsplay.com/signup, or you can point your phone to that QR code, and that will take you to a page where you can sign up for a free 30-day trial. It takes about 10 seconds to sign up, and that will get you started if you are joining us for the first time. And if you are, welcome to the Options Play team. So let's talk a little bit about what does it take to grow an options account. So three things that I generally think that you need to master if you want to grow your account consistently in the long run. Number one is gain confidence. And this really comes from fundamentally understanding why a strategy works. A lot of traders simply just follow what someone else tells them to do, and they have no idea why they're placing a trade in a specific security, a specific type of option strategy. They're just kind of following what someone else is telling to do, hoping that they'll be able to follow along and make money. And that inevitably never works in the long run because when a person goes through a series of consecutive losses, well, someone who understands the strategy can understand it and trade through it. But if you're on the other side, you're just following someone else blindly, whenever you have a string of losers, you don't understand why, you don't know whether there's something wrong with it, and you lose faith in that strategy. And what do? You jump to the next one. You jump to the next person who promises you that if you just follow them, you'll be profitable. And inevitably, that cycle keeps going, happening and happening and happening over and over again. And you never ever reach profitability from trading. And if anyone can relate to that, please type one into the chat window if you can relate to that, where if you don't really understand a strategy and you're just following what someone else is telling you to do, you're never quite successful. And what you do is you just go from one service to the next service to the next service, hoping that the next service will make you profitable, but inevitably none of them arguably do. And that really comes down to from fundamentally not understanding what that person's doing, why they're placing specific trades that they are, even if they are profitable as a trader themselves. The second thing that's required to do that is gaining consistency. Now, it might seem obvious, but winning more than 50% of your trades is actually not a requirement to be profitable. You can be profitable while winning less percentage than 50%. You could win 30 to 40% of your trades and still be profitable as long as those 30 to 40% of those trades make more money than the 60, 70% of the trades that you're losing money on. So however, I do tend to find that, while low probability strategies can still be profitable, a lot of traders have a tough time just psychologically being okay with only winning 30 to 40% of the time, even if they're profitable. It's just mentally much harder. It's mentally much more of a drain to have the majority of your trades be losing trades, even if you're profitable in the long run. So what we're going to talk about today is a credit spread strategy, which is a strategy that naturally on its own, just by trading it itself, will give you more than 50% winners. And what that's going to do is going to help boost your confidence. And then lastly, preventing blowups. Having the rules and discipline to prevent blowups and losing faith in a specific strategy. Most traders that I talk to will at some point in their career have traded something along the lines of, where they get out of a trade and they say to themselves, I lost too much money on that trade. And, you know, whenever you hear that comment that I've lost too much money on a trade, I always go back to the trader and say, it really had nothing to do with who you followed, what indicators you used, what the trading setup was, what the option strategy was. It all came down to how many contracts you traded. Because you can control how much money you lose based on how many contracts you trade. And that's something you decide before you get into a trade. It's not like a trade went horribly wrong and then you lost a lot of money. It's because you traded too many contracts. It's as simple as that. So we're going to go through all of these rules to help you prevent blowups and helping you stop losing faith in a specific strategy and just going from one strategy to the next. Um, let's now look at kind of the simple strategy that I want to help you learn, which is a credit spread. So those of you that have never traded a credit spread before, I'm presuming that many of you have, but for those of you that have not, it's an income generating strategy for when you have a mild directional view on a stock or ETF. What that means is that you don't need to have the strong thesis that you believe the stock is going to take off. You think this is kind of the best trades in the market. Just as long as you can identify a stock that's generally trading in one direction or another, that's all it takes to potentially sell a credit spread, which makes it easy for a lot of beginners who are getting started, who may not feel as comfortable reading charts, who may not be as comfortable understanding financial statements and understanding kind of all the complexities that may be involved with understanding a company. But you can kind of look at a chart and say, hey, this stock is generally trending higher, or this stock is generally trending lower, or it's trending sideways. Just basic common sense can allow you to kind of determine a mild directional view, and that's all that's required to get into a credit spread. It also is a forgiving strategy that has a higher probability of success, which is going to help you build confidence. You'll naturally win more than 50% of your trades selling credit spreads, at least credit spreads like the ones that I'm going to show you during today's session. And then the more important part is that it's limited risk and limited reward. So you know exactly how much money you can potentially make or lose before you get into a trade. And this is incredibly important in that last step of preventing blowups. You know exactly how much you could potentially lose. So there's no excuse at the end of the trade where you can say to yourself, I lost too much money on that trade. Because if that's the case, the only person you can blame is yourself for trading too many contracts. And that's, in theory, an easy fix because it has nothing to do with needing to learn technical analysis or trading strategies or anything like that. It's just as simple as math calculating how many contracts you should be trading. Okay, does that make sense, everyone? Please type 2 into the chat window if that makes sense to you. Perfect. Okay, so let's dive into some examples here. I saw someone make a comment saying finding trade ideas is the hardest thing to do. Well, we're going to show you how we're going to help you find trade ideas every single day that align with the things that we're going to teach you during today's session. So here's a trade idea that I found using our scans, and I'll show you kind of our scans here in a minute. This is Marvell Technologies. It's a semiconductor stock. It is moving higher recently in the last, I'll call it, a month or so. And like I said, you don't have to know much about the company. If you can read a basic chart, you can see that the stock is trending higher. It's making higher highs and higher lows. That's all you need in order to potentially get into a trading setup with selling credit spreads. So I'm going to show you structuring a credit spread based on how I would structure it, and then I'm going to walk you through why I structured it this specific way. So we're going to go out to the December 27th expiration, which is roughly 43 days from expiration. And what we're going to do is we're going to sell the $91 put option because the stock is trading just around 91. So we're going to sell the $91 put, the at the money put. That collects $5.75. But, so that is a neutral to bullish trade, meaning you would sell a $91 put if you believe that the stock is basically trading sideways or it's going to move higher. Like I said, you have a loose directional view. You don't have to believe that this stock is going to take off. As long as you think that the stock is generally going to stay where it is or move higher, you can sell a credit spread. So selling that $91 put is a way to take advantage of that neutral to bullish directional view. It gives you that bullish view by selling that $91 put, and here you're collecting $5.75. However, if you were to just sell a $91 put, you would be risking $91,000 minus the premium that you're collecting. So we're talking about a fair amount of risk to sell one contract of a put option. Not to mention, you need a substantial amount of margin in order to sell that $91 put. So what we're going to do here is we're going to buy a lower put against that, an $83 put. We're going to pay a little bit here. We're paying $2.55, which brings our net credit down to $3.20, because if we're collecting $5.75 and we have to pay $2.55 against that, that brings our net credit down to $3.20. So we're collecting a smaller amount of credit, but instead of risking $9,100 on a specific trade, as you can see, my max risk now is only $480. So I'm bringing the total risk of this trade down by nearly 95% in exchange for giving up roughly $250 worth of potential income. I'm reducing 95% of risk for $250 worth of potential income. That is the risk. That is the trade-off that I like to make when we're selling these types of credit spreads, and that's what makes it suitable for even small accounts. If you're trading in a relatively small account, a few $1,000s, you don't have $9,100 to throw around every single week. But when you're selling a credit spread, you only have to risk $480. That's something that's far more manageable for smaller accounts. Okay, so in order to understand this strategy, one of the key components to understand is whenever you're trading a vertical spread like this, there's the distance between the strike prices. So the distance between 91 and 83 is $8 per share. Now, if we're going to collect $3.20 out of the $8 that is available, that is the amount of capital that is at play. Because whatever you can potentially make on a trade, which is the $320 that I'm collecting, the rest of the $8 is your total risk, right? So if you're collecting $3.20, the rest of the $8 is $4.80. That's going to be your total risk. And this relationship between risk and reward is incredibly important for you to understand in terms of understanding the strategy from a fundamental perspective. Okay, so we're going to come back to this in a few moments, but it's important to understand that the distance between the two strikes is what's at play. And if you can collect more income, you're going to risk less on the overall trade. So that's going to be an important element that we're going to come back to here in a couple of minutes. So as you can see, what we have a break-even price is $87.80, and what that means is the $91 minus the $3.20. That comes out to be $87.80. That is the break-even price. So the stock's currently trading at nearly $91. As long as the stock stays above 87, we'll be profitable, right? So this is a very forgiving strategy because the stock's already above 87. It's already above 87 by a few bucks. And as long as it stays above 87, it will be profitable. So let's take a look at kind of the outcomes of this specific trade, right? So I've identified a stock that's trending higher here. I'm trading a bullish credit spread here on Marvell. I've sold the December 91.83 put vertical, collecting $3.20. Let's see how this plays out. So if let's say sometime in the future, the stock rises, right? Either it rises significantly, rises modestly, or just simply stays put around where it is right now. Well, in that particular case, in all three scenarios, I'm going to make my full $320 profit. So if I believe that the stock's going to move higher, I'm going to be profitable, right? I'm trading a bullish trade. But what's really interesting about this specific strategy is that even if the stock doesn't move, I'm still going to make my full profit, the full $320, if the stock just simply stays put to where it is right now. That's really kind of an interesting characteristic, if you will, of selling options is that you can be profitable if the stock moves in the direction you expect it to. And even if the stock doesn't move, you'll still be equally as profitable, right? Not true the same as if, let's say, you were to buy the stock or to buy a call option. Now, let's say the second scenario, the stock dips a little bit, right? So I think the stock's going to continue its bullish trend, but instead it just consolidates and maybe pulls back a small amount. Well, this is really kind of where the true forgiving nature of the strategy comes into play, because even if the stock pulls back a little bit, I can still be profitable. There's not many instances where you can potentially get the directional view incorrect on a trade and still be profitable. But when you're selling credit spreads, that is the case. Now, you're not going to be as profitable, but you can still be profitable as long as the stock is between 87.80 and 91. And as the closer it is to 87.80, you're going to make zero. The closer it's to 91, you're going to make 320. It's basically a linear scale, depending on where you land in between those two numbers as to whether you make 320 or make zero on the specific trade. But as long as it's within that range, you can still be profitable. Okay. Now, in the third example, as the stock now starts to drop, meaning your directional view is incorrect, right? The stock drops. This is really where you will start to see some losses. Not the full loss, but some loss. If the stock is trading between the break-even price of 87.80 and the lower strike price of 83, you will see some losses up until $480. So if the stock drops to as low as 83, you will see a loss of $480. If it's around 87.80, you'll see a loss of around zero. And then the last scenario, if the stock is below 83, this is really where you're flat out incorrect on the view. Basically this spike higher was a bit of a false breakout and the stock retreats back into the trading range. If that's the case, you maintain your full loss in this particular trade. And the benefit of this type of structure is that if, let's say, the stock really implodes, right? You buy the stock or you get into this credit spread and some terrible news comes out from a fundamental perspective or earnings comes out and the stock drops 10, 20, 30% overnight. Well, you are to some degree protected because the most you can lose is the $480. You cannot lose more than that, even if the stock goes to zero. So you have protection on the overall loss that you have on the trade, which again allows you to calculate the appropriate number of contracts when you get into the trade. So if you can only risk $1,000 and on any one trade, if you trade two contracts of this, no matter what happens, you will not lose more than $1,000 on this trade. So you'll never be in a position where all of a sudden you've lost $3,000 or $5,000 on a trade because it didn't go in the direction that you expected to. So very important to do that type of work and that analysis beforehand in order to um, to prevent account blowups. But what we're starting to show you is just a strategy in terms of its characteristics. The fact that as soon as you identify a stock that's trending in one direction, you can trade a vertical credit spread that can help you basically take advantage of that mild directional view, and it's quite forgiving in nature. But the trade-off with the high probability of success trades is the fact that you have negative risk reward ratio. You can potentially lose more than what you can make on a trade. And that's really an important element for us to go back to and understand, because that's where we have to try to find the best setups to help prevent those types of negative risk reward, or to skew the negative risk reward in our favor. So we think about kind of whenever we identify a stock that has a directional view, that we have a directional view on, a mild directional view, such as in Marvell, the way to structure a credit spread that gives you the kind of the payoff graph that we've just discussed in our example is to generally go out about 45 days from expiration is the rule of thumb that we generally have with these types of strategies. Going out 45 days will give you kind of the sweet spot between having a fair amount of time decay, an acceleration in time decay, which is working in your favor as an option seller. But what it doesn't have as much of is gamma risk. Gamma risk is something that happens more so in the last 2 to 3 weeks as you approach options expiration, where even small moves in the underlying stock generate significant swing in the options price that you own. And as an option seller, what you want to do is avoid that, because a small move, adverse move against you in the last couple of weeks can turn your trade from a positive trade to a negative trade, a profitable trade to a losing trade in a very short amount of time. And that's what you want to prevent, right? So even though you have acceleration of time decay as you get closer and closer to expiration, that comes with this higher gamma risk. And what we're trying to do is avoid that. So 45 days is the sweet spot where you basically have a fair amount of time decay, but you don't have the same amount of gamma risk for a specific trade. That's going to give you some advantages as traders that we're going to discuss here in 1 minute. Okay. And then what you're going to want to do is you want to sell an at the money call or a put. That's why we sold a $91 put, because the stock is trading just around 91. And what we want to do is we want to buy back a 25 delta call or a put against that, offset the overall risk. We're going to go through that here in 1 second, but the 25 delta put at that time was the $83 strike price. Most options chains or most options platforms will calculate delta on each strike for you, including the OptionsPlay platform. When you select your strike prices, you will see the delta next to it. And what this does, the delta-based approach allows you to have a more consistent approach to your trading, because you're using a probability-based approach to selecting your strike prices. When you use a probability-based approach to selecting your strike prices, you will find more consistent results day after day, because you're constantly selecting strike prices based on their probability of expiring worthless. So a really important element of this type of strategy. And then the most important of all of this, right? If you follow the expiration and strike price rules, the number one rule for selling a credit spread is that you have to collect at least 1/3 of the vertical width, or 33% of the vertical width. So before we said that this is an $8 wide credit spread. What we want to make sure is we collect 33% of that, which is $2.66. In this particular case, we're collecting $3.20. But the minimum that we want to collect on a credit spread is going to be 1/3 of that vertical width. And I'm going to show you here in a second as to why that's such an important rule for selling credit spreads. But before we get to that, does that make sense, everyone? Please type 3 into the chat window if that makes sense to you. Perfect. Okay, so in this example where we sold the $91 put and then bought the $83 put, we sold the $91 put, bought the $83 put. That is a difference in strike prices of $8. Like I said, if you were to collect 33% of that vertical width of $8 is $2.66. And what we said before in the beginning of the webinar is that whatever you collect in income, the rest of the $8, the distance between the two strike prices, is your total risk. So if you collect 33% of the vertical width, you collect $2.66, you're going to be risking $5.34 or so. That gives you a risk to reward of about 2 to 1. So for every $1 you can potentially make, you're going to risk $2 on the back of that if you collect 33% of the vertical width. And that's going to require 67% of your trades in order to break even. 67% of your trades have to be winners in order to break even. So if you have two winning trades where you win $1 each, you have one losing trade where you lose $2, you have two winning trades where you make $1, you have one losing trade where you lose $2, and you repeat the cycle over and over again. What do you get at the end of it? Chime into the chat window with your answer. What do you get at the end of it if you win $2 at once, lose $2, win $2 at a time, lose $2, win $2 and lose $2? And looks like everyone's answered correctly. Zero. Big fat zero. Big fat goose egg. A lot of traders will ask me, why would you ever trade a strategy where your expected outcome or expected value on a trade is effectively zero? Well, I always tell traders, most traders are not at profitability. Most traders are not profitable. This is the threshold at which you must trade anything. You do not want to trade anything worse than that. And the goal here is to simply get traders to just break even at first. Learning how to break even is a milestone that a lot of traders have not achieved yet. So what we're trying to do is help you understand what is the minimum requirement trade for you to make in order to kind of get to a state of consistency in your trading. And this is really where selling credit spreads, where you collect at least 33% of the width, is your starting point. However, that's not what we're shooting for. What we're shooting for are examples like the one I just showed you, which is if you were to sell a $91 put and then buy back the $81 put, you want to be able to, or $83 put, on this $8 wide credit spread. What you want to be able to collect is not 33% of the width, but in this particular example, we were collecting $3.20, which comes out to be about 40% of the vertical width. So as we said, whatever you can potentially make in potential rewards, the rest of it is your total risk. So if you collect 40% of the width here, like we did in $3.20 on the Marvell trade, you're only going to risk $4.80 instead of the $5.60 or so. And that brings your risk reward down to about 1.5 to 1. So for every $1 you can potentially make, you're only risking $1.5. That means it only requires 60% of your traders to be winners in order to break even. So if you have two winning trades where you win $1, you have one losing trade where you lose $1.50, you have two winning trades where you win $1, one losing trade where you lose $1.50, that's when you start becoming profitable and you start having positive expected outcome. And this is the end goal of what you're trying to achieve when you're trying to find credit spreads that provide you with an edge. Does that make sense, everyone? Please type 3 into the chat window if that makes sense to you. Perfect. Okay, so now here's the thing, is that when we talk about finding edge, right, finding trades that have an edge, what we talked about up until now is just edge from the options trading perspective, right? How do you find credit spreads where the amount of risk that you're taking on is relatively small to the amount of risk that you are potentially making on a specific trade? So that's the edge that you can get on the options trading side. But that doesn't talk about the edge that you can get on the technical side from a timing perspective. Because if you look at kind of a stock that's in a trend, right? So in the previous example, we saw a stock that was starting to make higher highs and higher lows, trending higher. So how do you use that to your advantage? Well, when the stock is trending higher, you can sell credit spreads at any point in this trend, and largely you will be profitable regardless of the timing of your trade. However, that doesn't mean that the timing of every trade is the same. So, for example, if let's say you were to sell a credit spread when the stock was right here, well, would you have made money on that credit spread? The answer is likely yes, right? But the problem is that you would have had to sit through a few weeks of chop. You would have potentially gotten stopped out, but likely you might have just held this trade and had to suffer through a few weeks of worth of pain before the trade turned profitable. Same thing here. If let's say you were to enter the trade right here on this bar on the high, right? Will you be profitable? Yes, but you would have had to sit through a week worth of losses eventually to see your trade to turn back into a positive and turn yourself into a profitable trade. If you got into the trade here, would you have been profitable? Yes, but you would have had to sit through some pain, eventually probably a couple of weeks or 3 weeks worth of pain before you get to a point where you could take profits on the specific trade. So as you can see, the forgiving nature of this specific strategy is really incredible because as long as you identify a directional view, you don't have to time the trade. You can get into the trade and expect that over the long run, you will be profitable with this type of strategy. However, when you can time the trades correctly, meaning when you have identified a bullish setup and you wait for pullbacks of that specific setup, what you can do is enter these trades at a much more optimal time. If you were to enter the trades at these pullbacks, what you would have been able to do is basically take profits within just a few trading sessions. So instead of having to sit through pain, you would have been able to take profits in maybe a week or two at most and be able to reach near your maximum profit in just a short amount of time. And out of these trades, you would have had maybe one or two trades that ended up being losers, where long term the trade ended up turning south. But overall, if you were able to catch a long-term trend and you wait for the kind of the optimal bullish entries, which are pullbacks within a bullish trend or rallies within a bearish trend, right? So if you've identified that a stock is starting to make lower lows and lower highs, what you want to do is you want to wait for rallies in that specific trend to enter that bearish trade. Because if you wait, then you can be profitable within a very short period of time versus having to sit through some pain or sit through a few weeks of the trade before you're able to turn a profit. And that's really kind of where, if you want to generate consistent weekly income, you want to be very selective with your trades and only trade the best possible setups from both a technical perspective and as well as from an options perspective in order to gain that edge so that you can get into a trade and get out within roughly a week's time, even though you're selling a 45-day option. Does that make sense, everyone? Please type 4 into the chat window if that makes sense to you. Perfect. Okay, so that begs the question. How do you find trades like the one that I did in our trading setup, where like Marvell in this example, where the stock is trending higher here, it's pulled back a little bit within that trend, right? So these were some of the pullbacks that we've experienced, and what we're looking for is that continuation, right? Because if you're patient and wait, what you have is kind of the opportunity to potentially make your full profit in about a week's time or so. Usually you tend to find some of these moves happen over about a 5 to 7 day period, but you have to be patient and wait. You can get into the trade here, you can get into the trade here, and eventually the trade will be profitable, but you would have had to sit through a few weeks of kind of unrealized losses before you can see that profit materialize. So again, that begs the question: how do you find trading setups like the one that we do, where you have alignment on the technical perspective, but also you have a credit spread that collects closer to that 40% of that vertical width on a credit spread? And that's really where we built a tool that's designed to fully automate everything I've taught you here today. Finding trades where the credit spread generates at least 33% of the vertical width on very liquid underlying, so that you know that you can execute those trades at the midpoint. There's no bigger waste of time than doing all of an equity research, looking at the technicals, looking at the fundamentals, bringing in an options chain, and then finding out the options aren't very liquid and that you can't reliably get filled at the midpoint on a trade. So this is really where we filter out nearly 95% of all optionable symbols from our scanning universe, so that whatever scans that shows up in our scans, you can execute those trades without any issues getting in and out of those trades near the midpoint. And then lastly, what we do is we also align these with our technical directional view, meaning we're waiting for those pullbacks in those rallies, or we're waiting for those rallies in those bearish trends to try to time the markets as well. So we're trying to do all three things for you so that you get a report where anything that shows up in that report aligns with all three things. And that's where I found the Marvell trade for today's setup. This was a trading setup that was discovered by our scanners that you can find in the OptionsPlay platform. Within the OptionsPlay platform, on the upper right-hand corner under Ideas, we have technical trade ideas, which are trend following ideas and counter trend ideas for those of you that are looking for equity ideas. And then what we do is we offer credit spread opportunities on some of those ideas when the credit spread that we're collecting is closer to 40% of the vertical width. And this list is sorted based on what percentage of vertical width we are collecting on that trade. So as you can see, Amgen, we're collecting 44% of that vertical width. Reddit, we're collecting 44%, Ally, 43%, Tesla, we're collecting 40%. I'm going to use Tesla just because that's a name that I think most of us are familiar with. The stock is down nearly 6% today on the news that the Trump administration might be getting rid of the EV tax credit. That's hit a lot of the EV players pretty hard, including Rivian and Tesla. So maybe you think that these concerns are a little bit overblown, and you certainly think that this pullback here is an opportunity because you don't necessarily want to chase things like this. You want to wait for pullbacks in order to take that next leg higher here, especially if you believe that the next administration may be favorable to Tesla from a policy perspective. This is really where you could potentially look at entering a longer term bullish opportunity on this pullback here, and you're going to collect 40% of the vertical width. So we're selling the 310 puts, right, which are the at the money puts, buying back the 280 puts, which if we look at kind of the 280 puts, as you can see, that's the 24 delta. Before we talked about the fact that we want to buy back the 25 delta. So the closest strike price of 25 deltas is $280. So we sold the 310, bought the 280 on the December 27th expiration, which are 43 days to expiration. And if you trade that specific trade structure, you're potentially making $1,200 on this trade if it's above 310, and you're risking only 1747. So you're risking in this particular case less than 1.5 times of what you can potentially make. So you have alignment on the credit spread perspective. You're collecting closer to about 41% of the vertical width here. You are finding stocks that are highly liquid and stocks that are experiencing a bit of a pullback in what is the start of a bullish trend here, like we have in Tesla. And this basically automates all of that work for you so that you don't have to do the research yourself, because it would take an incredible amount of time to find these technical setups, then wait for the pullbacks, then seek if there's a credit spread that kind of meets your requirements. So this basically does all the work for you so that you just simply have to find stocks that you are comfortable with and familiar with, and you're ready to kind of potentially trade. So here's one on Zoom Communications. Zoom pulling back to $82 here today, which is around here. So in this long-term bullish trend, it's pulled back here to 82, and we're looking for is that potential continuation here. Looking at Applied Materials, this is another bullish trading setup where we're collecting 39% of the vertical width here. This is a stock that, as you can see, is not particularly moving much higher here. It's marginally moving higher, but it's mostly moving sideways. So despite the fact that it's moving sideways, it's trading near the bottom end of that range. So that also is the potential for this to simply move sideways, and that is also a viable trade here as well. But you can quickly look through these trading setups, find the ones that you like the best. Out of these, I probably am looking at Tesla, that I like in terms of the chart setup here. It's just recently broke out to new highs. It's pulled back here to a much more reasonable level, and this gives me a risk reward level that's far more favorable for selling credit spreads. So out of these examples, without having to do any more research on the stock, on the credit spread, I can find great trading examples like the one here, like Tesla here, in just a few minutes, execute that trade, and hopefully within a few days being able to take profits on a trade like this. Does that make sense, everyone? Please type 5 into the chat window if that makes sense to you. Perfect. Okay, so let's go back to the slides here real quick, because I do want to end this with some of the questions that I saw here earlier today, which were around how to manage these credit spreads. So first of all, when we think about exiting a credit spread, there are generally three rules for potentially exiting a credit spread. You can take profits, you can cut losses, and there's also a time-based approach to managing a credit spread because, as I said before, time decay is working in your favor as an option seller. But time decay, or rather gamma risk, starts to eat away at that acceleration and time decay as you approach the last 3 weeks. So there's a time-based component to this as well. So if if you sell a credit spread and you lose 100% of the maximum potential gain on that specific trade, it's time to consider cutting your losses and moving and getting out of the trade. Meaning you don't want to lose that $1.50 for every $1 you could potentially make. If you could potentially make $1 and you've lost $1 on the trade, don't hold on to that trade any longer because your chances of it turning back to be profitable is not very high. And what you can do is is uh, is save some of the potential losses for the next trade. So as a general rule of thumb is that you generally want to cut losses if you've lost 100% of the max gain. So if you've sold something, in this particular case, we sold the 110, 120 call spread. I'm sorry, 100, 120 call spread, and we collected $8. That means our maximum profit potential here is $8. So if this spread trades from $8 to $16, that means I've lost 100% of the vertical spread, vertical width. I'm sorry, the 100% of the maximum profit on this specific trade. So if a spread that's currently trading at $8 that represents my maximum gain expands out to 16, I've lost $8, which is 100% of what I could potentially make. It's time to get out of the trade. So instead of waiting for it to potentially lose all $20, or rather all $12, because $20 minus $8 your maximum loss, you basically want to cut your losses at $8 instead of letting it go, potentially all the way up to that $12 full loss on the trade. Does that make sense, everyone? Please type one into the chat window if that makes sense to you. Perfect. Now, if the trade starts to go in your favor, meaning you sold something for $8 and that spread is now trading for $4, that means you've made 50% of the total potential profit on the trade. That's really where you can start thinking about taking profits as well. You're going to take profits more often, having a profit level that's much closer to the current price of the spread than the stop loss level. And that's going to also increase your number of winners by taking profits at about 50% of the maximum profit gain. And you're going to find that when the trade goes in your favor, you're likely going to see that in about 5 to 7 days. If the trade takes off like the one in the trade examples I've shown you, where you've identified the optimal entry point, you will many times find that you can take profits within 5 to 7 days and not hold the trade, anywhere near the roughly 30 days that a longer term trader might hold on to this trade. And lastly, if the credit spread that you sold, that's roughly 45 days from expiration initially, gets down to 21 days to expiration, and it has not hit your take profit level or your stop loss level, that's also a good indication of potentially it's a time to get out of the trade. Because in that last 21 days, that's when your gamma risk gets the highest. That's when your risk on the overall trade offsets any potential gains that you get from the theta decay, from the time decay of the short option that you've sold. A lot of traders like to sell short dated options because, the thinking is that, oh, I'm going to get a maximum time decay. But maximum time decay comes with a substantial amount of risk of gamma risk. And that's something that a lot of traders don't anticipate. Part of it is because gamma is much harder to understand and wrap your head around as a second order derivative. But this is something that most traders overlook is that, yes, I'm getting an extra, 10 cents a day in terms of income, but what you don't really account for is the fact that even a small move in the underlying security can swing your profits substantially from profitable to a losing trade. So that's why it's really important that if you have not reached profit or loss on a credit spread and you're 21 days from expiration, time to get out of the trade. You can sell a new 45-day credit spread if you still have that directional view. And nothing wrong with that, but you just simply have to roll it out and collect more premium with a longer dated option rather than holding onto the trade in that last 3 weeks from expiration. Does that make sense, everyone? Please type 2 into the chat window if that makes sense to you. Perfect. So that concludes what I wanted to share with you here today. Like I said, the most powerful tool that's designed here is the credit spread scanner. And that's under, like I said, under the idea section. If you click on the drop-down menu, you have cover calls, short puts, and technical ideas. One of them is credit spreads. And that allows you to find the optimal credit spreads based on the current market conditions. You can see there's no credit spreads that collect less than 33% of the vertical lift because that's the minimum that we want. But what I really focus my attention are the ones that are on the top of the list, the ones that collect 40, 41, 42%. 43, 44% is really rare. A lot of times those comes down to sometimes bid-ask spreads are wider and they look like they're slightly better than expected. But overall, generally speaking, you'll get on these trades, you'll get filled, where the premium you collect is 40, 41% is very common where you can get filled all day long on these types of trades. 43, 44%, those tend to be a little harder sometimes to get filled. But we're here to help you find the best trading setups that you can quickly click on a chart, click on a trade, be able to review the chart, make sure that the chart aligns with kind of your views, right? So this is the stock that just broke out, right? So this is a good example of a stock that just broke out. Instead of chasing that trade, you're being patient, you're waiting for that pullback. And if you're patient on that pullback and the stock takes off, you're able to take advantage of that. Actually, I take that back. This is a bearish trade. This is a bearish setup here in Allies. So this is a stock that's been trending higher, trending lower here. And what we waited for is this kind of rally here to look for a continuation lower. So this is actually a bearish setup. I apologize. But this is kind of what we're looking at is kind of these type of trend lines. So instead of chasing these stocks when they make new lows, we'd be patient. As you can see, if you had chased these lows, you would have sat through quite a bit of pain and quite a bit of chop here. But the fact that we're waiting for this rally up to this trend line, that gives you a much better entry for a bearish trade, looking for that continuation down to that $32 level here. And when you're selling a trade like this, you could potentially, like I said, make a profit within 5 to 7 days on a trade like this. So this tool is helping you find these trade setups. And then more importantly, you can use our risk and investment calculator, calculate the appropriate number of contracts. So here, as you can see, I can sell 10 contracts of the 3639 call vertical on Ally Financial. And I know my max risk will never exceed what is my risk tolerance, which is $2,000 in this particular case. And you can set your risk tolerance in your profile by putting in your portfolio value. We will automatically calculate 2% of that. That's your default starting point. You can risk more if you want, but I don't encourage people to do so. But you can even maybe set it at 1% for those of you that are a bit more conservative. So whatever percentage of your portfolio you're willing to risk per trade, you can put this as a default in your profile. And then every single time you place a trade, if you just use the risk and investment calculator, it'll automatically calculate for you the appropriate number of contracts so that you do not blow up your account. So with that, like I said, that covers what I wanted to share with you here today. I hope that this is helpful in giving you a better understanding of this one strategy, how it gives you a potential edge from a technical perspective and from an options perspective, and more importantly, how you can find trading setups just like the one I sent you here, I showed you here today, every single day on your own using our platform. So if you do not already have access to OptionsPlay to find these scanners, you can sign up for a free 30-day trial at optionsplay.com/signup, or point your phone to that QR code. And we just posted a link into the chat window for those of you that want to just click on that link and set yourself up for that free 30-day trial. That will also give you access to the recording and the slides from today's session so that you can follow along at your own pace, especially if this is new to you. You're going to want to review how to structure a credit spread. You're going to want to review the rules for closing out a trade. So take the time, make sure you understand that, master this stuff in a practice account sometimes before you execute your first live trade. With that, what I'll do is I'll open this up for Q&A. I have a few minutes to be able to answer some questions. So type your questions into the Q&A window, and I will answer as many questions as I have time for today. Let's take a look at the Q&A questions here. So, in the previous session, you discussed a poker approach to options. Is it applicable to credit spreads or mostly for debit spreads? It's applicable to all strategies because, playing poker is really about thinking like about risk to reward on every single trade, right? So it doesn't matter whether you're trading credit spreads, debit spreads, iron condors, long calls. Every single trade has its own characteristic in terms of its probability of profit, its risk to reward. So poker kind of just trains your brain to think in those terms that you need to be able to make good decisions as to whether or not you should place a trade, and it allows you to do so to train hundreds of hands, thousands of hands in a short period of time. For you to get thousands of trades under your belt to learn, it could take you years to get there. Playing poker, you can get there in a few weeks. So that's why that's applicable to any strategy. You can make a safer bet by selling a put that is further out of the money, but the return is less. So that's exactly right, right? You can, let's go back to that. I'm going to use the Tesla example here real quick. Let's go back to our Tesla example. So in this particular case, I'm risking, I think, what was it, $1,800, $1,700 to make $1,200, right? 1,750 to make 1,250. The comment that someone made is you can sell something that's further out of the money that gives you a higher probability of profit. So here I'm reaching 70% probability of profit versus the original trade that I had was about 55, right? Doesn't 70% probability of profit sound better? Sure, it does, but look at how your risk reward. For every $1 you can potentially make, you are risking $4. That is a risk reward that is not going to work out for you in the long run because all it takes is one bad trade to wipe out a substantial number of winners. And that is something you want to avoid. And that is exactly why we don't sell credit spreads that collect less than 33% of the whip. It's really what we call picking up pennies in front of a freight train. You can do it and you're going to win a lot of times. You're going to feel good about that until the one time that it doesn't work out for you and you wipe out a large number of gains on a single trade. So that's why I'm not a fan of selling out of the money, far out of the money credit spreads where you have a high probability of success. Does Ivy rank play a role in credit spread selection? It does. So generally speaking, you're going to find that the best trades have a high Ivy rank. It's not always true. There are some instances where you are able to find credit spreads even when Ivy rank is low because it has to do with skew, not just the Ivy rank. But generally speaking, as a general rule of thumb, yes, high Ivy rank would generally give you higher opportunities to generate more income like this. Um, There's another question here, along the same lines about lowering the deltas, and my take is that it's not worth it. How often is this credit spread updated? This is updated once an hour. So if you look out throughout the day, you're going to see multiple trade setups, multiple updates to that throughout the day. What environment on credit is fit to use would work full time decay 145 days. Cost of premium directional. Thank you. Um, so the question is what environment on credit spreads? So, any of the stocks that we've identified in the credit spread report here, as you can see, there's only 9, right? So, on any given point, we've basically done all of the work and taken out all the stocks that don't meet your optimal environment to sell a credit spread, so that any single time you see a trade that makes sense to you on this credit spread report, we're basically saying you have the optimal environments to sell a credit spread. So you don't have to wait for it. Our report basically automates all of the work for you so that any trade idea you find using our credit spread report has already met the optimal requirements for selling credit spreads. We wanted to automate 100% of the work that is required to find the best credit spread opportunities in the market. Um, how can this be weekly income? So here's the thing. If you are timing your trades correctly, like I said, most of these trades you're taking profits within 5 to 7 days in the shorter end of the spectrum, right? And that doesn't mean that you're only trading one trade a week and you're turning a trade profitable every single week. the idea is that you're going to trade multiple trades throughout the week, and then within every given week, you're going to have a few trades that you're going to be taking profits on, where you will be profitable on that trade. So this is really kind of where you're not trading a single trade once a week. You're trading multiple trades at once, and many of the trades you will find will last, as short as 5 to 7 days, and you're getting out of the trade, even though you're entering a trade that technically has 45 days to expiration. If the stock drops, can you buy back the long put and let the short take assignment on the stock and start selling cover calls? 100% you can do that. So, June asked this question, right? So, June, this is a good example of someone who clearly has a better understanding of kind of the components of a credit spread. They're thinking about it as individual components. By buying back by closing the long put, you basically are left with a short put, which gives you the obligation to buy the stock. If you like the stock, it gives you the opportunity to buy the stock at a discount. And now what you can do is you can sell cover calls against it and generate more income. That turns your short-term trade into a long-term investment. And, for certain stocks, you might be happy to do so. I would say, majority of the stocks, you might not want to do that because you may not necessarily have a long-term view on that stock. But if you do have a long-term view, that's a good example of what you can do to adjust a losing short put position. In Canada, it's getting harder to get brokers platforms to allow credit spreads. So, you know, TD, Questrade, and Interactive Brokers are the three that I would probably recommend at the moment. But Bank of Montreal recently also just launched multi-leg options trading. There are more Canadian brokers that are offering this type of strategy. So I highly recommend that you take a look at some of the brokers that do offer multi-leg trading for Canadian investors. So right now, TD, Questrade, Interactive Brokers, and Bank of Montreal are sort of the leaders in that particular space, offering multi-leg strategies and support for those. What about a bearish credit spread? So that's, in this example here, as you can see, what you can do is you can sort these based on, the bearish or bullish, right? So here, as you can see, Amgen is a bullish put, Red is a bullish put, Ally is a bearish call. So there are some bearish call opportunities right now. Right now, we only have one in Ally. But the other ones are all bullish. But if you come back here tomorrow, every single hour these are updated, you're going to find new opportunities for both bullish and bearish trades. Someone's asking about, will we start integrating some of these tools into TradingView? So we've been talking to them for a while. Sometimes the best request comes from customers. So if you reach out to TradingView and let them know that, you've seen our integrations into other charting packages and you would really like to see them integrated to TradingView, please, send that feedback to TradingView. That's going to help them make their decisions as to whether or not they integrate our technology into their platforms as well. Has anyone ever compared the theoretical probability of options finishing out of the money versus the historical probability of past incomes? We have done a lot of that, Tom. We have back tested, the probability of expiring worthless against history for nearly 25 years now, and you'd be surprised at how accurate Delta is at telling you the probability of expiring worthless. There's a reason that traders use that metric to help determine what the probability of a call or put expiring worthless is, because it's been an incredibly reliable indicator over the past 25 years that I've been back testing these types of strategies for. Do you recommend doing more contracts on a spread? So, and it's not that a spread you can do more contracts, and the spread has less risk, right? So if you're trading a spread and you have less risk, then you can afford more contracts, right? So in theory, the short answer to your question is yes, but you always want to stay in your lane. Just because you're doing spreads doesn't necessarily mean that you want to do more contracts. But if you are trading something with less risk, then you can afford to trade more contracts. Can you use Delta as a guide to exit your short put when the stock drops? Um, I'm not sure what you mean by using delta as your guide. The deltas of on your short put will obviously increase as the stock drops. And if you're saying that, do you have like a delta based approach to determine when to exit? You certainly can. But it's much harder to get the deltas of a leg um in real time. And also, your broker can't help you execute trades based on deltas, right? You can't, or at least most brokers, you can't say when this contract reaches X deltas, close me out, right? They all do it based on a price-based approach. So that's why, I give you advice using a price-based approach. But you probably can use a delta-based approach. It'd just be much harder to manage that, practically speaking. Can you change the percentage of your width if you want? Say if you want to look at 30% of the width instead of 33% of the width. No, we will only look at credit spreads that collect at least a minimum of 30% of the vertical width. Do you ever sell one leg? Should you always close both legs of a losing trade? You should always close both legs on both entry and exit for both profit or loss. Uh, I generally do not recommend ever breaking it apart. How does the options play score relate to premium versus width? The higher the premium versus width percentage you're collecting, the higher the options play score. The lower the width, the lower the risk reward, the lower the options play score. It's an important element to that goes into the options play score. What is the optimal credit spread width to set up a trade? There's no optimal width. The width is really just the nature of the stock price. The low price stock will have a lower width. The high price stock will have a higher width. That's it. In your Tesla example, why not use a $5 wide for a 1-to-1 risk reward ratio? Because if you have a $5 wide credit spread on Tesla, then your net delta is virtually zero, meaning you have very little exposure. So that even the stock moves higher, yes, you have a 1-to-1 risk reward ratio, but the credit spread's not going to move by much because the two deltas are so close to each other. Whatever you gain on one, you're going to lose on the other. So that's why, if you trade a $5 wide credit spread on Delta, you're going to be I'm sorry, on Tesla, you're going to be holding on to that trade for a while because you really need time decay to come in and work out on that trade because Delta's not working in your favor. How to close multi-leg options positions. You do both legs at the same time. You do not break those up. Um, I think those are all the questions that I see here for today. I see one question that's somewhat unrelated, but I'll answer your question, Paul. You're asking about what is a Bloomberg terminal. It is basically in a very expensive news service offered by Bloomberg. It is about $2,500 a month that I get access to it. And the question, is that where the best information comes from? It is where you can get some of the most comprehensive information. I don't know about the best information. They certainly have real-time news wires on Bloomberg, but you can subscribe to real-time news wires elsewhere as well. It's not exclusive to Bloomberg. They do have some of the widest coverage across all markets. And it is also deemed as the most expensive messaging service in the world because it allows you to message anyone else who has a Bloomberg terminal. And generally speaking, uh, top portfolio managers at big banks and asset managers and hedge funds all have Bloomberg terminals. So it sort of an inner circle, if you will, for those people to be able to message each other on a Bloomberg terminal that you can't do elsewhere. So with that, that covers what I wanted to share with you here today. I hope that this is helpful in giving you a better understanding of one specific option strategy that I think everyone should master if you want to help grow your trading account. And more importantly, why it's important to you, why it fundamentally works, and how you can find trading setups like for it every single day. With that, thank you so much. I hope you guys have a great trading day, and I'll see you guys here next time.